ne? After 2 January, where do you think you are going to put this? This is 40 days now. This is 40 days back. It's no longer 20 days back. 20 days back it was here. Ne? This is 40 days back. Ne? That means this is how many months? If it is 40 days, how many months? It has to be 2 months. The reason why it has to be 2 months is that we are having only 20 trading days per month. How many days are we having? It's only 20 days. That means, as for you, if you want to analyze the market or if you want to know where the bigger movement is going to go, that means you will have to have a 20-day range. If you want more money or you want another bigger structure than the one that you are using, that means you will have to add another 20 days. Don't add 10 days. Ne? Don't add 10 days. Add 20. Only 20. That means it's 20, 40, 60, 80, and 100. You understand, right? That means 100 days, it's having how many months? It's having 5 months. In 100 days, that means we will have to have, in 100 days, that means we will have to have 5 monthly candles, monthly range candles. So if you go to your monthly candle now and you measure the high and the low, you will have to know that on that monthly candle there are how many days? There are 20 days, 20 trading days, not 20 calendar days. You will have to differentiate between the two. You will have to differentiate between the calendar days and the trading days. On the trading days, per month, we are only having 20 days. Go to your Nasdaq and count how many days and come and prove me wrong here if you think you can. So now we are going to 40 days, ne? 40 days back. So if it is 40 days back, that means you will have to know that the market, if it's going down here, if the market has to go down, if you are saying now, okay, the market has to turn now, ne? Let me remove this. If you are saying now the market has to turn to come to where is 40 days back low, you will have to know where 40 days back low, what happened in the previous 40 days. You don't have to always use, let's say, those those these lines. If you want to learn price action and you are still using these lines, you are still doing this, ne? You will have to know that it's not possible for you to become profitable. You can just pretend like you are being profitable or you can take trades. But the reality is that you cannot take trades. Because if you know how to take trades, you will have to know how to define your daily bias. Because it's very important to know your daily bias. You don't have to work on support and resistance because remember, if you're a support and resistance trader now, let's say let's say the market was around somewhere here, and you are a support and resistance trader, then you are expecting that the market will have to come to this high. When the market is here as a support and resistant trader, what you are going to do, you are going to sell the market. Why are you going to be selling the market? You're going to be selling the market thinking that the market is going to go down, and you find that the market is now going up. So after the market is going up now here, you've been waiting, let's say, since 11 January. Now it's around 18 January, and the market it's taking you out. Like you have take so many days to plan or to prepare for this trade, thinking that let's say when the market reaches here, I'm going to sell. And when the market reaches there, you just sell and you just find the market going up. You will never know what made the market go up. You will just think that the market just had to broke the structure. And sometimes you will find that it is wrong, because as a support and resistant trader, while you find the market is here, you are supposed to sell the market targeting, thinking that maybe you can target this low, and you just find that the market is still creating new highs. Because remember, now the market is creating new highs. These highs that it's creating now on 2024, they were never created before. So for me to study price action, this is what I had to do, man. So let us remove this gap, man. I want to show you. Do you see here? Do you see this range now? This is 20 days. That is 20 days. That is 20 days range. This is a 20 days range. This was from there to there. It's a 20 days range. That means now we are on our highs. If we are on our highs, what do we expect the price to do? We are on a daily time frame now. Where do we expect the price to go? That is what you have to know. So you can now see that this is the low. This this high. The reason why the market targeted this high, ne, it's because it was inside this 40 days back range. Imagine if there was no, if let's say, imagine if there was no this other 20 days range going forward, ne, you are only having this range from here up until here, ne, you were going to say that this was the only high on this range, on this 20 days. On what happened on December, this was the only high, and this was the low on what happened on December. Now you can see now on January, the market created a low and a high. If it was supposed to go down, it was going to create a high and then go down. But now it just had to create a high and a low. Then it had to continue. It never went back here. A lot of people, or some people, maybe they saw this gap. Let me show you which gap. They saw this gap, this gap, this gap. I will tell you why am I showing you this gap now. So I want you to know why is the market likely to go up or why the market is likely to go down on a bigger time frame. Then we'll go to a smaller time frame. So I want to show you the reason why this gap failed. Ne? As you can see, the market didn't reach this gap. Ne? Didn't reach this gap, but it's a gap here. The reason why this gap failed is because this gap, it broke the high. Do you see where this gap is? That's the reason why this gap was failed. It failed because here it was it this was the block that break. It already break. After breaking here, imagine there was no this. other January trade. You are around December. I want to show you what happened there. For you to, you can just go to a daily time frame and just wait for this around the first month. Every let's say every month, you can just go and look for these setups or for these patterns every month. So now you can see now the market broke this structure using this, broke this structure and it went up. Then after breaking this structure, what did the market do? The market created a gap. Where was the gap? This was the gap. The market lifted this structure on December. It lifted this structure on the 12th of December and it came back again on 5 January. Why did it came back on 5 January? It didn't come back on 20 January. It had to come back in the second week of trading. So just know that in the second week of trading, you are expecting to buy. If you are buying, you are supposed to buy up until maybe the following month or up until 25. Let's say you ignore the first trading week, ne? Then take the second trading week. If you are taking an entry, you are supposed to take an entry on Tuesday. Ne? On the second trading week. After taking your entries on Tuesday or you are taking your entries on, but sometimes it will depend. But make sure that on Tuesday you try to look for a setup. If it fails, try to look for another setup on Wednesday and hold until. That's when, if you are looking for, if you're expecting the market to go to a bigger, to break a high, that means if you took your trades here, if you took your trades here, that means if you took your trades here, yeah, this one rallied on Monday, but it rallied on Monday. On Tuesday, that means that's when you were supposed to take your entries. After taking your entries, the market was going to go with you for you to take out this high. The reason why, or you were supposed to be in, is that the trade was already influenced, or you were supposed to just enter here. The reason why you were supposed to enter on this gap, not this gap, is because this gap was already broken. This gap break this one, this buy side, so it shifted up. So it was not supposed to come back again here where it shifted. It was supposed to come where it created a gap. This was the gap. And you can see that if we go to a smaller time frame, that's where the market is going to be more. And on this gap, guys, you have to know the lows and the highs. I want to show you what I was trying to show you there. Now we are on a 1 hour time frame. Let us remove this season breaks. No, what's going on now here? We're not doing this. So now we are on the 1 hour time frame. I will have to explain again. To You can see now what happened. You can now see what happened clearly. the problem is just that it's not going to be that clear. But for you, you will have to look at what I told you. Ne? I told you about the days. Ne? This is the beginning of the month. Ne? This is the beginning of the month of December. You can see here it's 1 December. Ne? That means 40 days were supposed to be here. Yeah, 1 December. You can have to take it to midnight price. Do you see midnight price? Take it to 12 o'clock. Take it to 12 o'clock midnight. Then on 12 o'clock midnight, you saw that what did the market do on 12? This is what the market did. Ne? Before this gap, let me just remove this gap. Ne? We will take it back if it's necessary. But I was trying to show you why it did not go to that gap. You can see now, ne, on our 1 hour time frame, like there we were on 4 hour time, we were on daily time frame. Ne? On our 4 hour, on our 1 hour time frame, you can see now that the market created a high here on 29 November. Ne? After creating this high, what happened? The market went down and come here. After coming here, that means it here the entries were taken on Tuesday, right? As I told you yesterday that you take, if you are taking a buy entry or if you are taking a long entry, you take it on Tuesday and exit sometimes on Thursday. If the market is still going to continue, it will have to show you. How is it going to show you that the market still have to continue? It's not going to attack this high, and it's not going to attack this high. It's not going to attack this high if the market is showing you that it's going to continue going up again. It's not going to attack this high on Wednesday. If you find the market attacking this high on Wednesday, if it created a high and attack it on Wednesday, just know that the market is likely to reverse on Thursday. That means that's when you are supposed to take out your entries. But if you find that the structure that you are looking for, that you are expecting the market to go to, that structure the market has never, let's say that structure the market has never went back to it. Now it's Wednesday, you see that the market, let's say it's Wednesday, you see that the market is down here, but you entered on Tuesday, right? You entered on Tuesday. On Wednesday, you see that the market is going down here. You can see that your stop loss was here. It on Thursday, your stop loss is still far. It's still far. Do you see that? There was no way the spreads were going to reach to that because you entered on Tuesday. Then on Wednesday, which Wednesday? Then on Wednesday, the price dropped. You can see that on Wednesday the price dropped up until here. It's not far from here, but it dropped here. Ne? It wanted to take out people who entered here. Ne? So it was not your enemy. The reason why market can be your enemy is that you are the market makes you think, ne, gives you entries, make you think that it's time for entries. Then after the market is done with giving you entries, mostly it will come and clear them again. The reason why it's clearing them is because it's going to move higher. it's going to move high. So some people they can just open a trade here, ne, and just put some their